In the evolving world of digital finance, few phenomena have generated as much attention as Buy Now, Pay Later (BNPL) services. These platforms, which let consumers divide purchases into smaller, manageable payments over time, have reshaped how people shop. Spearheading this trend is Klarna, a Swedish fintech company that rapidly gained traction by offering seamless, interest-free payments on everyday purchases. But while Klarna initially rose like a shooting star in the financial technology space, its story has recently become a cautionary tale of overreach, risk, and the limitations of disruptive models. The appeal of BNPL. Why it took off. BNPL services cater to a growing demographic of digital native consumers, primarily Millennials and Gen Z, who are wary of traditional credit cards. The logic is simple. Buy something now, split the cost over several payments, and avoid interest if payments are made on time. For many, it seems like a smarter, more flexible way to handle expenses without the long-term commitments or complex terms associated with credit cards. Moreover, BNPL is often easier to access, whereas traditional credit cards require a hard credit inquiry and sometimes have high entry barriers. BNPL services typically run soft credit checks and approve consumers more easily. Klarna, for example, allows users to make purchases at the point of checkout without requiring a prior account setup, making the process nearly frictionless. Retailers also love BNPL. These services have been shown to increase average order values and reduce cart abandonment rates. Klarna's business model initially thrived on the idea that if you could spread out a $200 purchase into 4 $50 payments, customers would be more likely to complete the transaction. Klarna's meteoric rise. Founded in 2005, Klarna started as a payment processor in Sweden. Over time, it evolved into a BNPL powerhouse. By 2021, Klarna was valued at $45.6 billion, making it one of Europe's most valuable fintech startups. Strategic partnerships with giants like H&M, Sephora, and Adidas catapulted its brand recognition and market penetration. The company's colorful marketing campaigns and edgy aesthetic resonated particularly well with younger consumers. Klarna wasn't just a payment tool, it was presented as a lifestyle brand, encouraging users to shop boldly and live on their own terms. The messaging was clear. Klarna made life smoother, more stylish, and more convenient. In the background, investors were pouring money into the company at a record pace. Flush with capital, Klarna expanded aggressively into the United States and other markets, growing its user base to over 150 million across 45 countries by 2024. The cracks beneath the surface. Despite its rapid ascent, Klarna's foundation was shakier than it appeared. The BNPL model, while attractive, comes with inherent risks. Because the service is often used for small, everyday purchases, like a $30 meal or a $60 pair of sneakers, the risk of default might seem low on an individual level. But when these purchases are multiplied across millions of users, the aggregate exposure becomes substantial. By 2024, warning signs were emerging. Klarna reported a net loss of $47 million in Q1 of that year. While not catastrophic, it was a sign that profitability was elusive. Worse, by Q1 of 2025, Klarna's losses had ballooned to $99 million. A significant chunk of these losses, approximately $136 million, was attributed to credit defaults. Essentially, more and more people were using Klarna to make purchases and then failing to pay them back. How Klarna differs from traditional credit card companies have robust systems for evaluating customer risk. They assess creditworthiness up front, report data to credit bureaus, and impose higher interest rates or deny service when customers appear too risky. Klarna, on the other hand, often bypasses these safeguards. While it does conduct soft checks, they are not shared with other lenders, and users can access BNPL without impacting their credit scores, until they default. Klarna also differs in its visibility. Whereas a traditional credit line is listed on your credit report, BNPL loans often fly under the radar, at least initially. This makes it easy for consumers to take on multiple BNPL loans simultaneously. Surveys suggest that up to 23% of BNPL users have 3 or more active loans at any given time. Additionally, many consumers incorrectly believe that timely BNPL payments will help improve their credit score. In reality, they usually don't. Only 13% of BNPL users correctly understand this, according to LendingTree. Worse, missed payments can hurt your score, creating a lopsided risk-benefit equation. The role of AI and automation. In an effort to cut costs, Klarna began automating significant portions of its operations. In 2024, the company launched an AI-powered chatbot capable of handling 2/3 of its customer service interactions. According to Klarna, this AI assistant did the equivalent work of 700 full-time employees and improved profitability by tens of millions. On paper, this sounds like a smart move. Faster response times, lower overhead, and a more scalable support system. But it wasn't without issues. Many users reported frustrating experiences with the AI, especially when it came to more complex or sensitive issues. CEO Sebastian Siemiatkowski initially celebrated the AI shift, suggesting that automation was the future of the company. However, by mid-2025, he reversed course. In an interview with Bloomberg, he admitted that over-prioritizing cost-cutting had diminished service quality and damaged the brand. He emphasized a renewed commitment to human support moving forward. Regulatory backlash and consumer protections. As BNPL grew, regulators began paying closer attention. In 2022 and 2023, several governments, including the UK and Australia, began exploring legislation to bring BNPL under existing credit laws. In the US, the Consumer Financial Protection Bureau, CFPB, began investigating the major players in the sector, including Klarna, to assess whether consumers were being misled or harmed. Initially, it looked like BNPL would soon face the same regulations as credit cards. But in May 2025, the Trump administration voided a rule that would have formerly brought BNPL under the Truth in Lending Act. This gave companies like Klarna a temporary reprieve, but it also put the spotlight back on industry self-regulation. Consumer advocates argue that BNPL is essentially a payday loan in disguise. It allows people to finance non-essential purchases, like takeout or electronics, without safeguards, creating the potential for a debt spiral. And unlike payday loans, BNPL companies don't have collateral to reclaim. If someone defaults on a $30 order, what's the company going to do? Ask for the tacos back. The IPO that wasn't Klarna had long planned to go public in the United States. In March 2025, the company filed its initial paperwork with the SEC, signaling that the long-anticipated IPO was finally near. But just 1 month later, in April 2025, Klarna postponed the IPO, citing market turbulence due to newly imposed tariffs and economic uncertainty. Insiders, however, suggest another reason. Klarna was hemorrhaging money. While the company's user base was growing, so too were its losses. The core business model, lending money to people for low-cost purchases with little recourse if they default, was proving unsustainable. Looking forward, is there a way out? Despite all this, Klarna isn't doomed. The company still has a massive user base, strong brand recognition, and deep integrations with major retailers. But it faces a crucial inflection point. If Klarna wants to survive and thrive, it must address the structural weaknesses in its model. That means more stringent credit assessments, better consumer education, and perhaps a shift away from financing frivolous purchases. Klarna could also benefit from embracing transparency and working with regulators to ensure fair and consistent practices across the industry. There's also room for Klarna to pivot. With its infrastructure and user base, the company could expand into other financial services, like personal loans, banking, or investment products. This would allow Klarna to diversify its revenue and reduce reliance on BNPL. Klarna's story isn't over, but it serves as a powerful case study. It illustrates both the potential and the peril of financial innovation. On one hand, Klarna made payments more accessible and modernized how we think about credit. On the other, it showed what happens when user growth is prioritized over financial fundamentals. Buy now, pay later isn't going away, but it needs to evolve. Klarna's journey from meteoric rise to sobering reality should be a wake-up call for fintech founders, investors, and consumers alike. Because in the end, innovation without responsibility is just another way to repeat the mistakes of the past.